we get that little breakout, not only above 33, but maybe more important, 34, and hold there for a day or two and get that bullish cross of those short-term moving averages. I think we go to 35, 35.50, those old highs, and then through there, 38, 39. So then to get back to your premise, the first part of your question, gold-silver ratio maybe stays at 100. Gold catches everybody by surprise over the next 60 days and goes to 3,800, and silver goes to 38, 39. That would be the kind of the way I see that playing out.
President Trump's well-known affinity for gold benefits gold investors and producers alike, as his unpredictable trade policies inject fresh volatility into global markets. Gold prices have surged to new highs, with May gold futures rising 2.2%, an increase of $71.30 per troy ounce, to settle at $3,363.60 on Friday. The sharp jump followed Trump's latest threats on social media to impose steep tariffs on the European Union and companies like Apple, adding more uncertainty to already tense global trade relations. Amid the market turmoil, analysts argue that gold's rally is not merely speculative. CraigHemke of TF Metals report asserts that the uptrend is structurally driven, pointing to sustained central bank buying, increasing demand for physical gold, and a growing loss of faith in Western fiscal discipline. He dismisses concerns about a significant summer pullback in gold prices, suggesting that the market is entering a phase of new all-time highs. In recent trading sessions, gold briefly touched $3,246 during the European session before entering a period of consolidation, trading in a narrow $15 range through Monday. According to the latest Kitco News weekly gold survey, industry professionals have virtually no bearish outlooks and retail traders are regaining confidence following gold's strong performance. Hemke emphasizes that gold is more than just a price point on a screen. It represents a tangible physical asset that underpins the broader futures and derivatives market. He notes that many market participants, especially those relying on algorithm-driven trading, lose sight of the fact that the price is ultimately anchored to a finite physical commodity. Midweek, gold received another boost in safe haven demand after the U.S. Treasury's 20-year bond auction fell short of expectations. The disappointing results triggered a rise in long-term yields, with 30-year yields climbing above 5%, further steepening the yield curve and reinforcing investor concerns about the sustainability of U.S. fiscal policy. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
Let's start by, gold is not just a dot on a screen, right? I think a lot of folks, when I read Twitter, or even just see people on my site, sometimes get confused with the futures price, which is just, a price like anything else. It's just a dot on a screen traded by algos, but yet it's a physical commodity. And that physical commodity is what backs up all those futures contracts. And we had a note, and it's not like you could say it's not like the head of the ECB came out, in a press conference and said, oh, we got to be careful about the counterparty risk, in all these gold derivatives in London and New York. So it's not that, but a team of economists at the ECB put out a note back on Monday, officially on the ECB website, that said a lot of the stuff that you and I have been talking about for a decade, Elijah, about, the leverage that's applied within the futures markets and the forward markets, where 1 ounce gets hypothecated and rehypothecated, and you don't know how many physical ounces back up, or how many contracts there are, or how many digital ounces there are versus each physical ounce. And that's what the ECB economists were warning about. And so when you look at gold just as a dot on a screen and you go, well, every time it's been this far above the 200-day moving average, it eventually pulls back, and you start talking about, some arbitrary price of, 2,800. It's almost like some of these folks try to talk that into existence. The chart shows a fundamentally sound market that just keeps moving higher, in a pattern of, kind of two steps higher, 1 step back. We pulled back last week in price to the 50-day moving average and held it for 3 days, which is exactly what happened in early April after the Trump's tariffs announcements. And so I think this notion that gold's going to swoon through the summer, and pull back, it's, all the way back under 3,000 or something for people that are waiting to buy the dip. I don't think that's coming. I think the opposite's true. I think we're going to rally, beginning as soon as the calendar flips. Heck, it looks like it's already started. And I think new all-time highs are coming sometime in the next 60 days. These big banks have this massive exposure, against higher prices because of the way they manage their books. And that actually is a threat to the financial system. I mean, these are all things that, again, I'm like reading this going, does this guy subscribe subscriber to my site? I mean, we've been talking about this for 10 years. And so we'll see. Just that, what it reminded me of, because gold, there are a lot of things that have been driving price higher this week, right? The downgrade of the U.S. debt late last Friday after the markets closed, spiking long-term global interest rates, this passage of this big, beautiful bill that doesn't have any deficit or debt reduction at all. People thought, austerity and, they're going to balance the budget and Doge and all that's out the window. Okay. And so there's a realization now that's building that all that is out the window. And that's what the bond market is seeing that. So there's a lot driving price this week. But when I saw that, and I've seen the rally since, kind of reminded me, remember back in about Valentine's Day, Elijah, there's that article that appeared in the Financial Times about delivery delays in London. Remember that one? And we already kind of knew this was happening. It was this big wide spread between spot and futures, and metals going all over the place. And they're talking about, it was related to tariffs, allegedly. But when it got codified, if you will, in a mainstream source like the Financial Times, everyone, whoa, it caught like mainstream hedge funds and financial advisors and other mainstream sources kind of off guard. Like, wait a second, I had no idea. How is this happening? We didn't know this, but here it was, the Financial Times. And I kind of thought, in a similar sense, that's what that ECB note was. A lot of us, that follow gold intently and discuss it, and have for years, talk about that risk, because it's a fractional reserve system. And the risk that if you just keep deleting the physical, what did China import last month officially? Unofficially, because it's all mainly, through shades, not China's buying the PBOC. It's just everywhere. It's like 100 some odd tons, taking all this metal out from underneath the system. It forces a deleverage. And so anyway, like I said, I think that ECB note was just kind of a slap in the face, kind of like that article in Financial Times was. And that's kind of helped spark all part of what was driving gold higher this week. I mean, you can go back a couple years ago when the banks were actually getting net long in silver, and it was the hedge funds that were short. And you can see these things, because especially in silver, where it's a tiny market. But that, I don't think in this case, I don't think that's what we're driving at, Elijah. It's just the structure. If you want to just paint it as normal business operations, we don't make directional bets, that the banks have, in their vaults, whether they hold it themselves in London or for somebody else, and then they hedge that, right? That's what everybody says, they hedge that on the futures market versus a physical position in London. At the end result of that, how many times have those same ounces in London been hedged and sold forward? Because again, the London tries to tell you they got all these tons, in their float, and what saved them back in March? Well, central banks coming in and leasing gold in the market. Well, then how many times has this happened in the past? And how many times have those ounces been released, and reloaned? And it's this kind of like not necessarily like a pyramid scheme or a Ponzi scheme. It's this fractional reserve. Okay. There's a certain amount, there's a certain float, there's a certain amount of ounces that backs up this whole pyramid of derivatives on top of it, futures contracts and forwards contracts. And as you shrink that supply, it just stretches the leverage even farther. In 2024, I thought, well, gold will probably go to 2,300 or so, maybe 2,400, which was still going to be a good year, but it just kept going. And now it's continued to go this year. And I thought, what did I miss? I think the main thing I missed, and this is noted in that ECB piece from earlier this week, central bank demand and constantly being on the bid is depleting that Western supply that underpins that system. 34 or 3,500 cumulative tons of net demand from central banks in 22, 23, and 24. Unless they're leasing it back, and most of them aren't, then that's just metal that's just, shrinking that bottom part of the pyramid. And that's what the ECB is warning about, that eventually that creates really a systemic risk to those banks. And they're urging other banks to be paying attention to this so they don't get caught flat-footed if, within that, this counterparty daisy chain of all their different obligations, that there aren't stresses coming for the banking system there and here.
U.S. markets reacted swiftly on Friday to President Donald Trump's latest wave of trade threats, with major stock indexes and the dollar retreating as investors process the implications. Trump proposed a sweeping 50% tariff on European Union imports starting June 1st and a 25% tariff on any Apple iPhones manufactured outside the United States. The aggressive stance fueled concerns about trade tensions and their potential economic fallout. The dollar index, which tracks the greenback against a basket of major currencies, dropped 0.83% to 99.08. The euro gained 0.74% to trade at $1.1364, while the dollar weakened 1.07% against the Japanese yen. The dollar has fallen 1.5% for the week, putting it on course for its steepest weekly decline since mid-April. This weakness in the dollar further supports precious metals, particularly gold and silver. CraigHemke believes the dollar index could fall to 96 or even 95. If that scenario unfolds, Hemke predicts that gold could rally sharply to $3,700 or even $3,800 per troy ounce, levels not seen before. He notes that a similar surge occurred when the dollar index touched 98. Silver, too, shows bullish potential. Hemke suggests that if silver breaks above $34 and holds, it could quickly rise to the $35 to $35.50 range, potentially as high as $38 to $39. Goldman Sachs research echoes a similarly optimistic outlook for gold, forecasting it will climb to $3,700 per troy ounce by the end of 2025. The projection is underpinned by relentless central bank demand, with institutions across the globe purchasing significant volumes of gold each month as they seek to diversify reserves and hedge against currency instability. Let's get back to the interview.
All this discussion last month about, or even earlier this month, I guess, it's a crowded trade. No, it's not. I mean, by what definition? I mean, even the most recent surveys we see, 5% of all financial advisors have their clients with even just a tiny position in the precious metals. How is it crowded? Even by the commitment of traders reports, as of last week, we had the smallest cumulative speculative long position in gold since February of last year, before price even broke out. So how is it crowded? Or is it crowded because, price is in the 3,000s, so it must be crowded? You know what I mean? Are you trying to talk it into it's overbought. Well, by what measure? The monthly RSI maybe, but everything else, especially after the pullback, is not overbought. So what I think is going to happen now, gold rallied like crazy. As the dollar was falling from February 1st until middle of April. I think it was April 22nd, bottomed out at about 98 on the dollar index. That day, gold hit 3,500. Well, then it bounced. The dollar, inevitably, it's not like the dollar index is going to zero. There's going to be bounces. It got up through its 20-day, and on my side, we're like, okay, now we'll watch, because it's going to go to its 50-day, and there's all kinds of resistance at about 102, where the 50-day moving average was, a downtrend line, horizontal resistance, all that stuff. And it's exactly where it failed. And it rolled down, never got above the 50-day, took out the 20-day early this week, and now it's a little bouncing again as we record this on Thursday. But what if the dollar index now just continues down because all this profligate spending and no debt reduction and, concern, maybe Japan comes in and sells treasuries because they got to support their own bond market. So they sell treasuries, take those dollars, sell those dollars and buy yen so that they can go support their own bond market. What if the dollar index goes back down to 98 and then keeps falling over the next couple of months? It goes to 96, 95. Think gold's not going to rally? Of course it is. Like I said, the last time it was at 98, gold was 3,800. So I think, or 3,500. I think what's coming over the next couple of months is going to catch a lot of people by surprise because, again, they think it's just a dot on a screen. It has to correct. It's got to pull back. It's overbought. It's a crowded trade. And when it goes to 37 or 3,800 over the next 2 months, it's going to catch everybody by surprise. And then, it'll be due for another pullback. Yeah, it's been in a box for about 5 weeks between about 32 and 34. And this happened as well back in, I think it was February, and it was in a box, a $2 range for about a month. Then finally, then granted, the dollar was falling, right? Dollar really started to fall at beginning on about the 1st of February. So, there's other things that drove this, but it began to move up. For a short-term technical indicator, the 20-day moving average moved up and bullishly crossed the 50-day moving average. That drove a lot of momentum traders with the falling dollar, and it rallied $4. And it went from 30 to 34, 35. Well, we're sitting at that spot right now. It's starting to move up. The dollar's starting to fall. And that 20-day is like 10 cents away from crossing up. It becomes kind of self-fulfilling. If it can rally, price can rally. Well, it's only the last 20 days of price that's in that moving average. So you kick one out, you put the new one in, and the thing starts to move higher. So we're about to get that cross again. I really want to trade some silver. I want to venture into the COMEX casino and buy some calls. But as long as we're still in that box, going to stand by. We get that little breakout, not only above 33, but maybe more important, 34, and hold there for a day or two and get that bullish cross of those short-term moving averages. I think we go to 35, 35.50, those old highs, and then through there, 38, 39. So then to get back to your premise, the first part of your question, gold-silver ratio maybe stays at 100. Gold catches everybody by surprise over the next 60 days and goes to 3,800, and silver goes to 38, 39. That would be the kind of the way I see that playing out. my experience with silver, now again, this dates back to the last time it really took off, in 2010, 11. It's kind of, price is kind of self-fulfilling in creating its own momentum. All the traders, and everybody that wants to, really profit from it are like what I just said, like me. I'm not going to do anything until it takes off. I'm going to wait till it takes off. I'm going to wait for it to break out. And then everybody, once it does, then everybody starts to rush in and it creates its own momentum to the upside. I mean, that's how it went. We went from 18 to 48 in 100 days or something in 2011 of this accumulation. Well, now it's 32 and that's good. 35, 38. And it just builds on itself. And so it tends to just sit there, like I said, in this box like it was in February and in this box like it is now. And then it takes off on its own. I still, my forecast this year, I thought we could get maybe up 40 or 41 and then pull back, finish the year 37 or 8. Everyone's like, geez, I'm waiting for it to go to 80 like I read somebody on the internet said. And so when I say this, there's going to be people in your comments that say, I can't wait any longer. I've been waiting long enough. What do you mean next year? It's always next year. I think it's next year. If you want to really get that momentum going again, right? We need just more than you and I talking about it. And we need the institutions. We need the family offices. We need the hedge funds. We need everybody starting to pile in and really kick off that momentum train. This happened in gold last year. It broke out on the quarterly and the annual chart. Okay. Got out, got above, and that's got everybody's attention. And gold's now gone from 2,000 and 2,100 or so to what, 3,300. So it's rallied 50 some odd percent. I was hoping we'd get that annual chart breakout at the end of last year. We might even have talked about it in kind of a year. Watch silver. Can it get above 31, 32 and, have post its highest annual close? Pretty good chance it's going to happen this year. So if that happens, if I'm right, we finish the year, even if it's just 35 or 6, anybody can look at then this really long-term chart and go, whoa.
The recent surge in gold prices reflects more than just short-term market reactions. It signals a more profound shift in global financial dynamics amid escalating trade tensions and weakening confidence in traditional fiat currencies. The heightened demand stems from central banks expanding their reserves and investors seeking a reliable physical asset amidst uncertainty, fueled by aggressive tariff threats and faltering U.S. fiscal outlooks. With key indicators pointing to a potential decline in the dollar, the stage appears set for precious metals to reach unprecedented highs, reinforcing gold's role as a cornerstone of economic stability in turbulent times. Could the ongoing trade conflicts and dollar weakness accelerate a historic rally in precious metals, fundamentally altering the global investment landscape? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.